So in first video of final adjustments of accounts, we discuss about how to calculate depreciation, up to how to calculate the depreciation. Then now we will talk about how to record depreciations for final accounts. How to record depreciation for final accounts. So depreciation double entry is depreciation account debit, provisions for depreciation account credit. Sometimes we can tell that as income statement debit, provisions for depreciation account credit. Income statement debit, provisions for depreciation account credit. So both are same. Finally, whether we recorded to the depreciation account even, it will come to the income statement. So the depreciation value will be recorded as the, finally will be recorded as the expense at the income statement, and it will be minus from the assets value at the statement of financial position as accumulated depreciation. That is the value we recorded to the provisions for depreciation account. So provision for depreciation account, there is a previous year value. So previous year's value plus this year value all together will recorded to the accumulated depreciation to the statement of financial position. Then we will talk about disposal. What do you mean by disposal? Dispose. It means we removed something from. It means disposal of non-current assets. For some period of time, we are using non-current assets in the business. After the period of time, its efficiency will be reduced. Then business organization will decide to sell the non-current assets. So selling non-current assets is called as disposal of non-current assets. When there is a disposal of non-current assets, we have to calculate whether there is a profit or loss from the disposal process. From the disposal process. To calculate the disposal profit or loss, we have to prepare a disposal account. Now I will tell you the double entries of recording disposal procedure. Firstly, the asset cost value should be recorded to disposal account. It means it should be removed from the assets account and recorded to the disposal account. Then how to record? Then how to record means we have to debit to the disposal account. The first double entry is debit, disposal account debit, assets account credit. Shall we think we had a motor vehicle account. Motor vehicle account we have 400,000 balance. From that 100,000 cost, motor vehicle was sold. Then 100,000 will be debit to the disposal account and credit to the motor vehicle account. Then that 100,000 valid motor vehicle, we may have used some period of the time in the business. So for the period of time we used it in the business, we have to calculate the depreciation. Then that depreciation value should be removed from the provision for depreciation account and record to the disposal account. Then disposal account, provision for depreciation account debit, disposal account credit. Shall we think that same asset has been used in the business for 3 years, so total depreciation is 30,000, as we take as 10,000 per year. Then provision for depreciation debit 30,000, disposal account credit 30,000. The asset was sold for 60,000. In cash book debit 60,000, disposal account credit 60,000. Then disposal account debit side is 100,000, credit side 30 and 60. Then 30 and 60 totally 90. So it is lower than the cost. Then 10,000 is there. That is the loss of disposal. So that will be finally income statement debit, because it is a loss. So if the 30,000 depreciated, 100,000 cost was sold to 80,000, then 110,000 will be credit side. Then 10,000 is debit. It means profit of disposal. Profit of disposal. It will be debit to the disposal account and income statement credit. So that is the disposal procedure. Then we will talk about bad debts. What do you mean by bad debts? So all the business organization will continue the business by selling goods on credit. So if the business sold goods on credit, they will have debtors, trade receivable. Sometime business organization will not receive cash from the debtors. So in that situation, business organization will have to forget it, because if they leave the country, if the person is died, if the person become a lunatic person, shall we think, in the present situation, if the person died because of corona. So we have to forget that. Bad debts. Then bad debts is expense. So income statement debit, debtors, trade receivable account credit. So that is the bad debts. Then we will talk about final adjustments, provisions for doubtful debts. All the business will do a provision for the doubtful debts. They know that they will have to face to some doubtful debts. So in that case, they will have to give a provisions for doubtful debts. Provisions for doubtful debts will be done as a percentage of the trade receivable. 5%, 4% of trade receivable. So provisions for doubtful debts will be debit to the, so it will be calculated firstly. Then provisions for depreciation account is there. So you will have to, the percentage you will have to record to the provisions for depreciation. It means trade receivable account, provision for depreciation account debit, trade receivable account credit. Then provisions for depreciation account, there will be a balance, there is a difference between the opening balance and closing balance. The difference will comes to the income statement as over provisions or under provisions. If there is over provision, it will be other income. If there is under provision, it will be other income, other expense. So other amount, total amount will be deducted from the trade receivable at the statement of financial position under current asset. So these are the total adjustments for the final accounts, as we learned. So now you can try with all these adjustments, how to do all the adjustments for the final accounts. Okay. Have a nice time to all of you.